Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. Today, we are going to be talking about going into a little more detail about some of the tax advantages that we've talked about in the past. Our last episode was on syndication, and I said that there would be a part two, and I still believe that we're going to have a part two, but I think I'd like to bring on another syndication expert that we can talk a little bit more about it. So we'll continue the syndication conversation in a future episode. And today I want to talk a little bit about some of the tax advantages in real estate, maybe some of the historical tax code that was in place that people are used to talking about. So I want to start with some of the I guess what people have almost been seen as a misconception in the last, probably in the last 10 years. And the reason why is because we have this, what we call standard personal property tax exemption. And this is what the average person knows about. It's the idea that when you sell your home, you don't have to pay, taxes on it. And so I want to go into the rules a little bit more on that and talk a little bit about like the house hacking method that we've talked about in the past, which kind of pertains to how you use, this tax advantage is why we use the house hacking method. But first of all, prior to 1997, whenever a person sold their home, they would be subject to capital gains tax unless they purchased a replacement home of equal or greater value. Now, if they downsized or they went into a smaller home, they would just have like whatever the difference would be their taxable, capital gain. So while many people didn't really have an issue with this, because when most people sold their home, they would buy another home and most people were moving up. The problem was, you would amass a lot of equity in your final home, right? So maybe you started with $100,000 property and then bought a $200,000 and then bought a, $300,000 and then bought a $500,000 and then bought $1 million home. And by the time you were kind of retirement age, you had $1 million property, maybe paid off in full. And maybe that $1 million that $1 million property was part of your retirement plan or even part of your, extended care, long care program, right? And so, when people were building through their retirement accounts and said, okay, this is what I'm going to live on, but the house would represent a tremendous amount of equity or a tremendous amount of their net worth. And so older generations were at a major disadvantage for this particular tax law as they transitioned into like retirement homes and long-term care. And so what would happen is they would sell their final home, again, usually a place that was paid off and they, represented maybe a large portion of their net worth or their retirement savings, and they would have to pay this significant tax burden. So what happened was back in 1997, we had what was called the Taxpayer Relief Act. It was the tax bill. I can't remember who was president in 97. I don't remember if that was Clinton. I think it was Clinton. But anyway, had the Taxpayer Relief Act of 1997. And it really changed the way that we paid taxes on personal property. So now instead of having to exchange your property and buy something new, again, because the people who were moving into a retirement home weren't buying anything new, they would have an exemption, okay, that was regardless of reinvesting the money or not. Okay, so that exemption was a $250,000 exemption for a single individual and a $500,000 exemption for a married couple. So if you bought a house for $500,000 and then sold it, maybe 20 years later for $1 million, if you were married, you wouldn't have to pay any tax on the $500,000 capital gain. Okay, and you didn't have to reinvest that money. So this basically took away the disadvantage that the older generations had moving out of their final home and into long-term care. Okay. Now, in order to qualify for this exemption, you have to have lived in the property for 2 of the previous 5 years, and they don't have to be consecutive. So just to give you an example, you could buy a home, you could live in it for a year, you could move out, rent it for 3 years or 2.5 years or whatever, move back into it for another year, and then sell it. So in that case, you would have lived in the property for 2 of the 5 years, of the last 5 years. And the other kind of caveat to this is that you cannot have sold another property in the last 2 years and claimed an exemption. Okay. So the nice thing about this exemption is it can be used over and over again. Okay. But you just have to wait 2 years in between each time. Okay. So realistically speaking, there's nothing in there that says you have to own the property for 5 years. It just says you have to have lived in the property, okay, and owned it, I guess, for 2 of the prior 5 years. So if you lived in it for 2 years and want to sell it and move, you can do that and take a full exemption up to 250 or up to 500,000, depending upon, being single or married. So, the other thing is that you could buy a rental property, for example, not live in it for 3 years, 5 years, 10 years, 15 years, and then move into it for the last 2 years and then sell it. And now you have a personal property exemption. Okay. So you can see that there's a tremendous tax advantage if you use this system properly. We have people that, for example, you can have a couple of, let's say you go buy a couple of rental properties. I have some clients that are kind of in a situation like this now where maybe they're 10 years out from retirement, okay, or they're 15 years out from retirement, and they're starting to think about that. And we say, okay, financially, what are you trying to plan for? What would you like your retirement to look like? And they say, well, we're really looking to maybe purchase a retirement home in Florida or in, wherever, California, wherever. Okay, we're looking to purchase a retirement home. So one of the things that we teach, one of the methods that we teach is, okay, well, if you're 15 years out from retiring, what about buying a couple of pieces of property, okay, maybe here in Colorado or somewhere in a nice appreciation state, buying a couple of properties that we're going to enjoy the appreciation. Okay, so let's say we buy 2 properties right now for $500,000 a piece, and we're putting 20% down payments on them. So we need to have about $200,000 in order to do that. Okay, so we're going to take $200,000, and what we're going to do is we're going to take those 2 properties and we're going to let them appreciate, and we're going to have some principal pay down over that time. Once we get to a point where maybe we're a few years out from retirement, what we can do is we can take those 2 properties and we can do an exchange, okay, into the new property. And we're going to talk about 1031 exchange. We're either going to get to it on this episode, or it will be the next episode if we don't talk about it today. But what we'll do is we'll take those 2 properties and we'll exchange those 2 properties into one property. Okay, so let's say we hold them for 10 years, and now both properties or each property is worth $800,000. Okay, so each property gained $300,000 in equity, and let's say over those 10 years we paid off, let's say $100,000 of the $400,000 loan. That's probably a little high, but we'll use that as a round number. So now we've got $800,000. We've turned our $200,000 into $200,000 of equity or investment into $800,000 in equity. Okay. Now, generally speaking, because these are investment properties, we don't get a capital gains exemption. Okay. They have to be personal properties. We have to live in them for 2 of the prior 5 years. Okay. Now, one thing you could do is you could go move into one of them. Okay. Live there for 2 years and then sell it and have a nice tax exemption. Okay. Most people probably aren't willing to do that. They probably live in a nicer home anyway and don't want to move into one of their rental properties. Okay. So what they'll do is we'll sell both of those properties. We'll combine the $800,000 of new money that we have now, and then we'll go buy that future retirement home in Florida. Okay, so now we have this future retirement home in Florida, and in order to exchange out of the rental properties into a new property, that new property also has to be a rental property. And there's some other regulations around it as well, as far as how much loan you have to carry moving into it, how expensive the property has to be, et cetera. So we can cover those more later or when we get into the 1031. Okay. But what we're going to do is we're going to take that $800,000 worth of equity and we're going to go buy that dream vacation home or that dream retirement home in Florida. And we're going to rent it for a couple of years as we prepare for retirement. Our last couple of years of working, we're preparing for retirement. So we've moved all that money, tax deferred in this case, right? The tax exemption is only for a personal property, something that you have lived in 2 of the 5 years. These 2 properties you have not lived in. So we only get a tax deferment by exchanging it and pushing it into another property. So we defer the taxes on $800,000 or $600,000 worth of gain by reinvesting it into another property in Florida. Now that property, after a couple years of renting it, we retire. We sell our property that we're living in here in Colorado. We take our personal property exemption from whatever equity that we built in that property, and we move to Florida down into our quote unquote rental property or our, retirement home. Once we have lived there for 2 years, those those capital gains taxes that were deferred now kind of disappear. Okay. Now, if you were to move back out of the property and start renting it again, and you didn't fall within the 2 of the prior 5 years upon sale, those taxes would come back. But once you've lived in the property for 2 years, and now that's your, let's say that's your, end of life home until you move into a retirement home, as long as you live there for 2 years before you sell the property, okay, all those tax deferred dollars just kind of disappear, right? So this is one of the tax strategies that people use to build up and get themselves into a nice, retirement home in their later years in life, right? So it's a very powerful and strategic tax program that you can use. And again, like we've talked about in the past, the tax code is like literally hundreds and thousands of pages of things that you can do and a handful of things that you can't do. Okay, so there are rules as to how you don't pay tax, right? So let's take this back to like the early phase of maybe like of a house hacking method. Okay, so the house hacking method of sorts kind of uses this strategy. It allows you to lock in essentially your tax-free capital gains as you work your way up. So every 2 years you can move and sell the home you were just in and secure the gains completely tax-free up to the limit. Now, obviously the caveat to this is we have to see some significant capital gains every 2 years in order to move, right? Especially when you have cost of sale and things like that. If you're buying properties and then you're selling them, using traditional sales methods, you're going to have a fee somewhere around, 6 to 7% of the sale price on the back end. So if you've only appreciated 6 to 7% in those 2 years, you really kind of break even after that. Right. So the idea is, if we're in a state like Colorado, for example, where over the last 20 years, essentially, we've averaged somewhere between 7 to 8% appreciation per year. And so if we look at that 7 to 8% appreciation and we live in a property for 4 years, we're going to be up $100,000 on a $500,000 property or even on a $400,000 property, and only pay 25, 30,000 to sell it. So we'll have gained 70 grand. Okay, so then you can take that 70 grand and reinvest it into a new property, and you can keep moving up, and you don't have to reinvest it. So, you can basically do whatever, but the exemption starts over on your next property. So if your first property you buy at 400,000 and you sell it at 500,000, whether you're single or married, you get a full exemption of that $100,000 gain. Then you go do another one a couple of years later, and you go from 500 to 700. That $200,000 gain is another full exemption, right? So, and you can do that over and over and over again. So if you were to, move every, let's say 5 years from the time that you're 25 to the time that you're 60, you're going to burn through eight to 10 homes. And the reality is if you have, if you have $100,000 or $200,000 worth of equity every time you move, you're going to lock in around $2 million worth of, $1.5 to $2 million worth of gains completely tax free. So this is why people will use that house hacking method to go through that. So let's talk about the law a little bit more. So the law made for very large exemptions throughout the United States, right? Especially back when this was passed in 1997, a $500,000 exemption was huge. Okay. But now what's happening is this law is falling a bit behind in some of the fast growing states, right? So like in Colorado, in Washington, in parts of Florida, in New York, California, a $250,000 or a $500,000 exemption doesn't even really begin to cover the amount of equity growth that some people have in their homes. So this is why it's really important to kind of keep an eye on the real estate market, right? So we have homes that in these bigger states these bigger growth states that have increased, $250,000 to $500,000 in equity in a year or in 2 years, right? And so we see properties that have gone from being worth $1 million to being worth $2.5 million in 5 years. And so what happens is that exemption gets far exceeded. And now, even though you're enjoying this huge amount of equity, you increase the value of your property $1.5 million. When you go to sell that thing, you're going to be on the hook for $200,000, $300,000 worth of capital gains. So, you could look at that and go, man, that's a good problem to have, I suppose. But at the same time, I think most of us are trying not to pay tax if we don't have to pay tax, right? So this exemption is falling behind a little bit in some of the bigger states. And that's why it's important to keep an eye on the real estate market. As you start to approach this $250,000 to $500,000 threshold, it really makes sense to start thinking about a move. Like, even if you're not in a position where you're like, man, I want to move, it may be financially relevant to make a move, even if it's to like buy the house across the street, right? Because after you exceed that 250 or that 500, you're going to owe that long-term capital gains tax on every dollar of equity. Now, depending on your level of income, that capital gain can vary anywhere between 15 and 30%, right? And so it's really important that we understand, like, if, every dollar after we pass that exemption, we're going to have to pay 30 cents to the government. There's a point where we go, okay, let's sell it now. Let's lock in the gain and buy something different. So, a lot of times there's, again, this kind of misconception, and people fail to realize when they hear about capital gains tax, is that capital gains tax is generally subject to just more than one tax, right? So the federal rate is between 15 and 20%, depending on your income level. Okay, that's what people think about. People think about a 15% a 15% capital gains tax. The problem is, at the state level, there may be another income tax. Okay, and there also could be, they could be subject to other tax depending on your income level. So, for example, in Colorado, at the state level, capital gains taxes or capital gains are taxed as ordinary income. Okay, so in Colorado, you need to add another basically 4.5%. Okay, so now if you're in the 15% tax bracket, okay, and now you're adding in the Colorado tax bracket, we're at another 4.5%. So now we're at 19.5%. You also may be subject to what's called the net investment income tax. And again, depending on your tax bracket, you might be at another 3.8%. Okay, so now that you understand the law, or kind of understand how the law and the tax exemption works, like, how do we use that tax exemption strategy to our advantage? Okay, so there's a lot of people out there that do a really good job taking advantage of this tax strategy. So one of the great ways that people do this is that they buy one of the very first homes in a new development, in a new build development. Okay, so as soon as a new build development comes up, you go and you buy one of their new homes. Now, generally speaking, the new home is going to be one of the cheapest homes that will sell in that development, because as the development continues to get built out, the developer is going to generally increase prices. Okay. And you're going to get some time. You're going to get that appreciation overall of the market. So you're going to get a little bit of a discount, kind of a quote unquote discount, for living through construction for the next few years, right? So if you've got a development that's going to be a 2-year or a 3-year development program, okay, you're looking at having, you're going to live through construction for the next 2 to 3 years. There's going to be dirt everywhere. There's going to be, incessant beeping of work trucks going in reverse. There's all kinds of stuff that, we have to think about when we're purchasing, new development. So the advantage is that after just a few years, you're generally going to generate great equity in the home, and you'll be able to sell the home just after the completion of the development. Okay, so builders come in, they build out the entire development, they sell their final new build there. It's completely occupied. All the homes are beautiful. The trees are starting to grow. Everybody's got green grass. There's no dirt. There's no beeping trucks. So people who couldn't get their hands on a new build, they're going to have to buy resale. Okay, so if somebody really wanted to be in that neighborhood, they got to buy resale. Now, most people aren't going to be ready to resell. They just bought the home. They just bought this brand new home. They're just moving in. They just got their yard in. So now you have 2 advantages. 1, you've already built equity because you were early in on the development. And 2, you are going to be one of the very few, if any, resales in that market. So somebody that's looking to get into that, neighborhood, we're going to have we're going to have this opportunity to resell and be the only one available, right? So as long as you live there for 2 years, you can sell for a tax-free profit and then go do the whole thing again, find another new build development. Now, obviously, you have to have the desire or the willpower to go, all right, we're going to move every 2 years and we're going to live through a construction zone, right? So it's important that people understand that obviously this is a great strategy, but there's some drawback to it, right? You're going to live in constant construction zones, but there's great opportunity to make a lot of money. So I've seen people make hundreds of thousands of dollars every couple of years working a strategy like this, right? So now, the tax exemption that you get on the sale of a personal property, like I said, it can be used over and over again. So as long as you haven't used it in the prior 2 years, like logistically, you could do this dozens of times over a lifetime. Okay. So the recap that I want to quickly go over on this episode is that, first of all, many people have lived in their homes so long or have been in their primary residence so long that they never knew about the Tax Relief Act in 1997. So I still talk to people to this day, and we are talking 26 years later, after this law was passed, 26 years later, that people still think that they need to reinvest their money after the sale of their property. They need to buy a new home. That is not the case. Okay. You no longer need to reinvest. That's only if you want to avoid taxes on an investment property, okay, a property that you do not live in, those ones you do have to invest. And that's what we call 1031 exchange, which we'll talk about in our next episode. Okay. So you do not have to reinvest. Okay. You can sell your home and not do anything with it. You can take the money and go spend it. You can put it in the stock market. You can do whatever you want with it. There's no requirement to reinvest it. Okay. And the exemption is $250,000 for a single person and $500,000 for a married couple. Now, one other thing I want to cover, because we run into this and I see, I've seen some major, I don't want to say, well, I guess they're major issues, or I guess I've seen some major tax faux pas when it comes to this strategy or understanding the tax code. I've seen a couple of things happen. First of all, one of them is when a spouse passes away. So again, the exemption is for a married couple, okay, 2 people filing a joint tax return is a $500,000 exemption. When someone passes away, that exemption will eventually become a single person exemption. Okay. So if that married person has their spouse pass away, after 3 years, the spouse has no longer lived in that property for 2 of the prior 5 years. And so the exemption will drop down to the single rate. Okay. So, and again, I know this is in my disclaimer at the end of the episodes, but my disclaimer here is that I'm not a tax attorney. I'm not a CPA. So take everything I say kind of with your own level of research. If you go, wow, this might affect me, talk to your CPA, talk to your tax professional, and make sure that you have the rules in line. There is a rule about when a spouse passes away, and there's a certain amount of time that they still can get that full exemption. And I can't remember exactly what it is, but I think it's between 2 and 4 years. So I think it's 3 because I think it just aligns with the law that way. But the important thing to understand here is that we realize that a lot of times people, when they have a spouse pass away, they've been a couple and they've been in a home for a very long period of time, and that home has gained equity. And what happens is we understand that maybe in that first year, it might be difficult to sell the home, and it might be, something where we're just going through that mourning process or whatever it may be. But it's important to understand that there is a time frame where all of a sudden, all this equity that you've gained in your home, the tax abatement or the tax, exemption is going to be halved if you wait too long to sell that property. So it's really important to understand that, in a situation like that, it is very important to talk to your tax advisor, a strategist, somebody that can tell you, hey, if you don't do this, or if you do this, this is what your tax burden is going to look like. Okay. The second thing I've seen happen, this one is really awful, is that there was a single mother who owned a home, and it had grown with a tremendous amount of equity over the years. It was something like she bought the property for $100,000, and the property was now worth just over $1 million. So it had grown almost $1 million in equity. And she found out that she had terminal cancer and knew that she was probably not making it past the year. She didn't want her property to have to pass through probate, and she wanted it to go to her daughter. And so what she did was, in this last year of her life, she added the daughter to title. She did what's called a quit claim deed, and she added the daughter to the title. Shortly after, 3 to 6 months after that, the mom passed away. Now, this almost pains me to talk about because it was such a blunder from a tax standpoint. So the daughter goes to sell the property because she doesn't live even in the state. So this is in a completely different state. She doesn't want the property, but it's worth $1 million. So she's going to sell the property and she's going to make $1 million, or that was her big chunk of her inheritance that would go to her. So, or at least that's what she thought. What happened now is, not only did the mom give up her $250,000 exemption, right? She could have sold the property prior to her death, taken a $250,000 exemption, and only been on the hook for, tax on $750,000. Okay, so she could have done that, which also would have been another blunder, but we'll talk about that. So she could have done that, and given the rest of the money to, given the $250,000 to the daughter plus the $750,000 minus whatever taxes. So she could have given that to the daughter, or she could have died with the property in her ownership, passed the property on to her daughter through a will or through a trust or through, or just through probate. It could have gone, if it was a probate state, just using the will to go through probate and go to her daughter. Her daughter would have acquired the property, and with current tax code, she would have gotten what's called step-up basis. So the step-up basis basically means that the daughter gets to acquire the property at the current value that the home is worth. So what happens is, upon death, an appraiser, you hire an appraiser, they appraise the property. Let's say they appraise it for 1.1 million. And now the daughter acquires the property at $1.1 million. If she sells the property now and sells it for 1.1 million, her acquisition price was 1.1 million and her sale price was 1.1 million. So not only does she not have a gain, but she might even have a small loss after she pays fees to sell the property. So she will have literally no tax burden on that, right? So if the mom owned the property completely outright, she will sell a $1.1 million property, and whatever she nets after paying fees and everything on it, she's going to walk away with over $1 million tax-free. Because she went on the quitclaim deed, okay, now her acquisition price is the same acquisition price as her mother acquired the property for, which was $100,000. So when she goes to sell it for 1.1 million, her capital gain is $1 million, and she gets zero exemption because she hasn't lived in the property and won't live in the property because she, lives out of state. So now she's got a long-term capital gain tax on $1 million, and that long-term capital gain is going to push her income bracket up to the point where she's going to pay 20% from federal. Okay, she's going to pay the net investment tax, and she's going to pay whatever state tax. So she's probably going to be on the hook for somewhere between 25 and 30% of $1 million sale. So it's literally between a $250,000 and a $300,000 tax blunder by adding the daughter to title, just so that the property didn't have to pass through probate. So this is an incredibly powerful example of why we need to understand, or at least have someone on our team, like a tax advisor or a CPA or someone to advise us what we do, right? Like, think about maybe the mother in this case, maybe called a couple of people, maybe called an attorney or maybe called a CPA and found out that, it was going to cost her $1,000 or $1,500 to get the advice that she needed, and decided, no, I just have a friend that told me if I add her onto title, then it won't pass through probate. And so she just did it that way. And she saved herself $1,500, but ultimately cost her daughter $300,000. So understanding these things, understanding the way that the tax code works, and it's why it's so important, and why we've had some episodes with, Clayton, who was on a few weeks ago, talking to someone who can help you financially plan and strategize through these things, because the financial blunders that can be made can be really significant and can affect not only you, but can affect your heirs and affect people that, affect your family that you potentially leaving, property or money to. So, all right, I think we'll stop there for today with the personal property tax exemption for selling your own personal property. And then our next episode that we're going to get into will be regarding 1031 exchange. So that'll be the tax deferment for investment property. I'm actually surprised that we're 20 plus episodes in and it's the first time we're talking about 1031, but it's very relevant. So we're going to talk about it, and it's a great way to, again, continue to build your wealth. So anyway, it's a beautiful summer here in Colorado, and hope it's beautiful wherever you're listening from. So take advantage of the beautiful weather and the great outdoors that we have, and go out and live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources. and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.